I want to talk about, as Bob said, the U.S. experience of inflation in the last few years, but I also want to talk about Israel. And it turns out it had a similar pattern, although inflation did not get as high. So the high score that Israel gets in the Economic Freedom Index for monetary policy is consistent with that. So here's the price level in the U.S. since 1950, just to get you a big perspective on it. And I've taken the natural log of the price level. So if you know how logarithmic scales work, it means that the slope of the line tells you the percentage rate of increase. If you just put raw numbers, it doesn't show you that. But you do a logarithmic transformation, and the slope corresponds to the, since it's the slope of the price level, corresponds to the rate of change of the price level in percentage terms, or the inflation rate. So you can see in the US, inflation was fairly low. The slope is pretty flat in the 1950s, starts to rise in the 60s, gets worse in the 70s. We hit double-digit inflation in the US in the late 70s and early 1980s. Then it moderates after about 1985, and inflation has been in the range of 2% during the more recent decades. But then comes this last little segment, which is back to almost to the steepness of the 1970s. So at the peak in June 2022, we had 9% inflation. That is, the price level was 9% higher than it had been a year ago. You can see that more directly if I switch from the price level to the inflation rate. So here's the inflation rate just over the last 20 years. And you can see it was pretty well under control. There were some swings around the Great Recession, but it was pretty much in the range of 1.5 to 2.5% until the pandemic. So this shaded bar is the recession corresponding to the pandemic. Then there was a short run drop in inflation, but then counter-cyclical monetary policy kicked in and the Fed overdid it. So inflation not only recovered back to 2.5%, it went all the way up to 9% in, this is year over year. So looking at June 22 compared to June 21. And since then, it's come back down. It's still above the Fed's official 2% target. In September, year over year, it was 2.4%. But if you shrink the period you look at, if you just look at the last 6 months, it's pretty much back on target. So what we want to understand is how the Fed let inflation rise so high before they reacted or before their reaction took effect. And think about what the lessons that tells us about the future of monetary policy. In the US election this month, well, the election day is next week, there's been a lot of talk about inflation, despite the current inflation rate, that is just the past 6 months, being pretty much back on track. And to understand that, don't look at just the last 6 months, look at the last 4 years. So look at the term of the Biden and Harris administration. And you can see that the 4-year percentage change in the price level shown here is around 20%, which is quite unusual in the post-war period. So that's an average of 5% a year for 4 years. That's well above the Fed's 2% target. And that's what people are responding to. They don't just remember what grocery prices were 6 months ago. They're remembering what grocery prices and other prices were 4 years ago. There's been emphasis on grocery prices rather oddly, I guess because people remember them, but grocery prices haven't risen more than the consumer price index on average. But the CPI has risen 20% in the last 4 years. So here's a similar chart for Israel since 2004. This is just the consumer price index that's made available by FRED. FRED is the Federal Reserve Economic Database. The series doesn't go back to 1950 for obvious reasons. But what you see is the price level rising at a moderate rate and then being practically flat for 6 or 7 years from 2014 to 2021, and then starting to rise a little more rapidly. And we can see that more clearly by looking at the inflation rate for Israel. And here it is. So this is year over year change in the monthly consumer price index. And from 2014 to 2021, it's averages close to zero. So that's pretty remarkable, and that will get you a high score for monetary policy on the Economic Freedom Index, because you can think of inflation as a tax on your money balances, and lower taxes means you're, in a way, more free. Uh, so your value of your money is not being eroded by expansionary monetary policy. I'll talk about the relative roles of monetary policy and other factors, supply shocks, and so on, in explaining the recent inflation. But in the pandemic, in response to the pandemic, monetary policy got looser in Israel as well. But the peak was only a little over 5%. And it's come back now to where it's the August figure for year over year inflation was 3.6%. So it hasn't come back down quite as far as the US has, but it didn't rise quite as far either. Let's sort of step back and ask what sort of factors can explain the inflation rate. And I think it helps to think about inflation not just as a rising price level, which is the definition of it. And there, the important point is that it's prices in general. It's not the price of one thing. And it drives me nuts when reporters say, well, the inflation rate was 5% and it was driven by the price of housing. Or it was driven by oil prices, or it was driven by food prices. There's the rate of inflation is defined as the average of a big basket of representative commodities. The consumer price index is measuring the prices of the goods that a typical consumer purchases. And you can customize it. You can make the urban consumer price index, where, of course, rent is going to play a bigger share. But no one price drives inflation. Rising rents are a symptom of inflation as much as rising food prices and just about everything else. Any price that rises more than the average rate of inflation, that's a relative price change. Its price is rising relative to other prices. And to explain relative price changes, we need to appeal to the supply and demand for that particular commodity. But to explain the rise in all prices together, I think it helps to think of it as inversely as the shrinkage in the purchasing power of the monetary unit. So if the monetary unit is the dollar, it's the shrinkage in the purchasing power of a dollar. And then it becomes natural to think, well, what's making the value, the purchasing power of a dollar shrink? It's growth in the supply of dollars relative to growth in the demand for dollars. We can measure that just by the inverse of the price level. So if the price level is measured as dollars per representative bundle, then the inverse of that, bundles per dollar, that's the purchasing power of a dollar. And the purchasing power of a dollar shrinks when the number of dollars grows faster than the willingness to hold dollars, the real demand to hold dollars. So that pushes the question back a bit. What controls the number of dollars and what determines the real demand to hold them? And how are these things affected by supply shocks and other events that are sometimes blamed for inflation? The New York Times took a poll in 2022 and asked people what they thought was to blame for inflation. And maybe this is a little bit of humor injected, because there's kind of a bias, or there's a kind of implicit theory behind the phrasing of the questions. So how much do you blame? Here are the candidates: the COVID-19 pandemic, supply chain disruptions, corporations, the American Rescue Plan. That was the Biden administration, well, Trump followed by Biden, plan to write checks to households to enable them to keep spending, even though they were no longer earning if they were idled during the pandemic shutdowns. And then last, the war in Ukraine. Some of these don't even qualify as potential explanations, like corporations, because they're not citing any change. If you wanted to blame corporations, you would have to say increased greed by corporations or something like that. There has to be a change. So the pandemic and supply side disruptions, those are at least changes. They are changes on the supply side of goods. So they're saying that to make sense of them, they're saying goods have become more scarce. Therefore, each dollar is chasing a smaller number of goods. Therefore, the purchasing power of the dollar is going down relative to goods. And that is a potential explanation for any sort of brief period why inflation was unusually high in that period. But if that were the right explanation, notice that that unusual height in prices during that period should reverse when the disruption is over. So when the pandemic ends, you should see prices going back down to the extent that it was the pandemic that raised them, or going back down to their usual trend at least. Likewise, for supply side disruptions or increased greed or the American Rescue Plan or the war in, well, the war in Ukraine is ongoing. So maybe that one doesn't self-reverse. But what's missing in this emphasis on supply side disruptions is the supply of dollars. And so none of the options say monetary policy. Maybe the American Rescue Plan kind of indirectly indicts monetary policy because the Fed became expansionary in order to help the administrations pay for the American Rescue Plan. That is, pay for writing checks to everybody who was out of a job. But that's as close as it comes. So forgive me for a supply and demand diagram, but I hope it's familiar to some of you, the idea that demand curves slope down and supply curves can either be upward sloping or they can be vertical if we're thinking about something that is in a kind of predetermined supply. So what I've drawn here is a money demand curve, and the vertical axis is the purchasing power of the monetary unit, 1 over the price level. And what the downward sloping demand curve tells us is as a dollar loses its purchasing power, people will want to hold more dollars just to make the same transactions, to buy the same bundle of goods. If the purchasing power of the dollar goes from 4 goods to, or 4 bundles of goods to 2 bundles of goods, you need twice as many dollars. You need to go from 1 to 2, or 1 million to 2 million in the number of dollars you need to buy the same bundles of goods. So that explains the downward slope, and it explains the particular shape where the horizontal coordinate times the vertical coordinate equals the same product. In this example, it's 4. 4 times 1, 2 times 2, 1 times 4. Everywhere along the money demand curve, the amount of purchasing power held is the same, right? Because that's what people care about when they decide how many dollars or shekels to hold, what they can buy with it. The initial equilibrium is shown by money supply being here, well, it's supposed to line up with 2, with the money supply being 2, and therefore the number of goods you get per dollar being equal to 2. If you then shift the supply of money, suppose you double it to 4, that 4 should be over here, the purchasing power is going to be cut in half. You're going to have $4 chasing every bundle of goods. You're only going to be able to buy 1 bundle with $4. When goods were $2 a bundle, you could buy 2 bundles. But when your purchasing power only buys 1 bundle, that's all you can get. So the equilibrium purchasing power is down to 1 at the new increase in the quantity of money. So the price level, we flip it back over, is proportional to the quantity of money, other things equal. If you double the money supply, you double the price level. you consequently cut the purchasing power of the monetary unit in half. So that's a kind of simple comparative statics, comparing two equilibria before and after a shift in the supply curve. Now, a standard way to analyze this is to think in terms of spending, and it's a accounting identity that total spending on GDP equals total GDP or national income. Right? So every dollar spent by one person is somebody else's income. If it's spent on newly produced goods and services, it's final income or GDP. Spending is measured in dollars per year if the monetary unit is the dollar. We can divide that or decompose that two ways, which helps sort of get behind the scenes. Spending dollars per year, you can think of as the product of the number of dollars held by the people spending times the number of times per year that each dollar is spent. Right? So if people hold 2 months worth of income and they spend all their income, then their spending will be 6 times their average money balances. So the velocity of money, so-called, symbolized by V, the ratio of spending to money balances would be 6. Right? So that's decomposing spending into the product of the money stock and the turnover rate at which the money stock is spent. Second way we can decompose spending by equating it to income. Income for any seller of goods is the number of goods sold times the price paid per good. That's the total income of the seller. And if we aggregate into bundles of goods, same thing is true. Number of dollars spent per bundle times the number of bundles produced by year. So dollars per bundle is the price index. If it's a consumer bundle, then it's the consumer price index. And the bundles per year, that's the real output of the economy, not measured in monetary units, but measured in bundles per year. So that's P for the price index times lowercase y for real income. And so that's known as the equation of exchange, and it's an identity, it's an accounting identity based on how we defined velocity. We defined velocity to make it spending divided by the money supply. All right, so that's comparing one price level to another. And you can think of the process of adding money to the economy much like the process of adding water to milk. So some TV station in India had an expose in which they found this milk seller pouring water into the cans of milk and then selling diluted milk. Right? When you add money to an economy, you kind of dilute the existing money. You're not adding any goods for the money to trade against, but you are adding more dollars with the same amount of things to be bought. So let's look at the resulting milk. Before the dilution, you have a smaller volume of fluid. After the dilution, you have a larger volume of fluid, so you need a bigger glass. But you notice it's paler, or muddier, it's half water. So even though you've got twice the amount of fluid, if you've added water equal to the milk, you don't have any more nutrition. You don't have any more calories. You don't have any more milk fat. You don't have any more milk in real terms. All you've got is more milk in ounces, in nominal terms. But if you want to get the same usefulness out of the milk, you have to drink twice as much. Just like when the value of the monetary unit's been diluted by 50%, you need twice as many units to accomplish the same transactions for goods and services. So the process of adding money to the economy has results like adding water to milk. Here's some more numerical evidence. So money growth and inflation show a positive correlation. If you take the this is in terms of the growth rate of the money supply and the growth rate of the price level or the inflation rate. So if we take the equation of exchange, which is in levels, right? M is in dollars, V is in times per year. So the product is in dollars per year, price level, dollars per bundle, real income bundles per year. Uh, that holds at any point in time. We can convert it to growth rates. You can take the natural log of each side and differentiate with respect to time, or you can just think about discrete changes and leave out the interaction terms. The growth rate version is that the growth rate of the money supply plus the growth rate of velocity is approximately, because we're leaving out the interaction terms, equal to the growth of the price level plus the growth rate of real income. So money growth plus velocity growth equals inflation plus real income growth. And that tells you that ceteris paribus, that is holding other things constant, and here the other things are velocity growth and real income growth. Given the velocity growth rate and the real income growth rate, increasing the money growth rate by 1 percentage point is going to increase inflation by 1 percentage point. And if you want to explain inflation rates of close to 40%, you got to have money growth close to 40%, because velocity growth is not going to be close to 40%. That just doesn't happen. And real income's not going to, it's on the other side, it's not going to shrink 40%. That doesn't happen even in the worst recessions. In the worst recessions, real income shrinks by 1 or 2%. So if you want to ask what explains inflation, by and large, in principle, it could be due to high growth in velocity in a particular episode, or it could be due to big shrinkage in real output. And that happens rarely, but that does happen. But by and large, high inflation can only be explained by rapid money growth, because velocity growth doesn't vary all that much, doesn't get that high to explain high inflation rates. Real income growth doesn't vary that much and doesn't get that low to explain high inflation rates, especially if we're looking across countries and if we're looking over long periods of time. So this chart is actually showing a 30-year period. So that'll average out bad years of crop harvests, recessions. It'll smooth all that out. The countries with high inflation here had high money growth. There's no other way to explain it. I circled the dot representing Israel during this period, because this is a period in which Israel had high inflation, one of the higher inflation countries in the world. It had close to 40% inflation, and it had close to 40% money growth. So it's pretty close to the 45-degree line that equates the two rates. But you expect to, under the equation of exchange, or under the theory that money is the principal driver of inflation, you expect the dots to line up along the 45-degree line, and they pretty much do. There are small differences, and those small differences have to represent, given the accounting identity, have to represent either a velocity difference or a change in real income between countries, differences between countries. When you get down here to the lower end, if you want to explain why some countries are more inflationary than others, you see there's a lot of noise. It's not that everybody is really close to the 45-degree line. Because if we're talking about 1 or 2 percentage points difference across countries, variations in velocity growth and real income growth are enough to explain that. But when we get to really big variations, only money growth is empirically big enough to explain that. So let's look at the post-pandemic inflation in more detail. And I'll first look at the US and then I'll look at Israel. So go back to the growth rate version of the equation of exchange. If we want to rearrange it to put money growth on the left, put the inflation rate on the left, growth of the price level, it can be explained by money growth plus velocity growth minus real income growth. People were blaming real supply side shocks. So they're blaming a drop in real output growth for the inflation during this period. And over this year, the inflation rate was 6.8% in the US. But it turns out it can't be explained by falling real income, because real income was actually growing during this period. The economy was recovering from the pandemic. And real income growth, it was a V-shaped recovery, was actually pretty high, 3.5% per year, or over that year, it was 3.5%. Whereas the normal growth rate in real income in the US is about 2% a year. That's been the moving average over the last decade. So real output growth was actually above normal. So that can't explain, that is, falling real income didn't happen, so it can't explain 6.8% inflation. Instead, what explains it is 10.8% money growth. That is growth in M2, which is total currency and deposits held by the public. There was hardly any change in velocity. It dropped at 0.2%. So inflation rate is closely approximated by money growth minus real income growth. And the reason inflation was high was that money growth was high. Real income growth was actually higher than usual, so it was contributing to restraining inflation. You get more goods chasing each money unit. It strengthens the purchasing power of money. And so inflation over this period was entirely due to money growth, or more than entirely due to money growth. Money growth over explains the inflation rate. And the difference is explained by more than rapid real income growth. Now, I gave a talk on what was happening 2 years ago, and I went back and looked at those slides. And here's a slide I showed 2 years ago. And what we saw in the early years of the pandemic was unusually rapid money growth. And M2 in the United States was up 25%. And yet in 2020, we didn't have high inflation. And that's because the money growth was offsetting a drop in velocity, an unusually large drop in velocity of 24%. Right? So if money growth had remained the same, there would have been a big deflation due to the drop in velocity. And you can explain the drop in velocity as a combination of two things. One, it was voluntary. People were stocking up on money balances because their income had become more uncertain. So people were delaying big ticket purchases and building up their money balances. So the ratio of spending to money balances was falling because money balances were rising relative to spending. And then secondly, there was an involuntary accumulation of money balances because things were shut down. You couldn't go out to restaurants. They weren't open. Couldn't go spend on movies. People weren't taking vacations. Everything was shut down. But I gave the credit, and I still give the Fed credit for offsetting the drop in velocity because that helps stabilize nominal income in the economy, which is a good thing to do if you want people to be able to repay their debts and to continue their normal level of consumption. But I did make this prediction, and you have to take my word for it that this reproduces the slide I gave 2 years ago. I said, look, as the economy recovers, velocity is going to come back to normal. And I based that on looking back here in the financial crisis, 2008 to 2010. Velocity drops below its trend then, but then it comes back. Right? So it drops during the shaded area, that's the recession. But after the recession, it comes back to normal, or it comes back to the trend it was on. So we have to expect velocity to return to trend. And if the Fed is not going to take out the extra money it put in to offset the drop in velocity, you're going to have high inflation. And the same thing was happening in Israel. Velocity was below trend, not quite as far below as in the US. And so the same thing was liable to happen in Israel as as velocity returned, that is the ratio of spending to money balances returns to trend because people decide they no longer need unusually large money balances and they're freer to spend. Spending will resume relative to income. If it rises at 12% a year, having dropped 20% below trend in the US, 14% below in Israel. This was kind of an arbitrary figure, but if it returns at 12% a year, you'll get inflation of 2% a year, even assuming no money supply growth. and assuming only the average rate of real income growth. And that turned out to be pretty close because it hit 9% a year in the US. It turned out to be an overestimate for Israel. Uh, as I said, it only rose to about 5%. So the Fed would need to withdraw the extra money if they want to avoid a spike in inflation. Unfortunately, they didn't do that. So here's the picture in the US. Here's the big period of rapid growth in the money supply, but it's offsetting this drop, this sizable drop in velocity. So that was fine, but velocity did in fact return to trend. And in fact, now it's over the long run trend. It's almost back to the level it was at before the pandemic. And so that means total spending has back to trend. Actually, it's above trend. And that means for inflation to remain at trend requires slower money growth or even negative money growth. And we did have a period of a short-lived period of shrinking M2 as the Fed tried to undo its injections. But although they offset the dip, if you look at this entire period, I put in a trend line for money growth. M2 is still well above its pre-pandemic trend, whereas velocity is back to and actually above its pre-pandemic trend. So total spending, M times V, is well above. And that means inflation is going to be well above when real output is back on its long run trend, which it now is. So because the Fed offset the dip but didn't pull the money back out to offset the return of velocity or spending to its normal pattern, we got inflation well above trend. Compare that to what they did in 2008 to 2010. Here we saw the velocity dip below trend. The Fed didn't do anything with M2. It continued, well, there's a tiny, tiny bulge. It basically continued on the same trend that it had been on, which had two consequences. One, you didn't get a burst in inflation after the recession because the Fed hadn't injected money more than usual. But secondly, it meant the recession lasted longer than usual because while velocity is below its trend, then total spending is below its trend. And so until prices come down, you have a lack of willingness to spend off money balances. So you get reduced spending, you get reduced real output. So they didn't have inflation afterward, but they did have a much longer recession, whereas the pandemic recession was very brief, as you can see by it only being 6 months. If you look at the rates of change of M2 and the consumer price index, here's the picture. Here's inflation. Here's M2 growing 25% at its peak year over year. And here's inflation rising 9% year over year at its peak. And the peak in inflation follows the peak in money growth because initially the growth in the money supply was offsetting a drop in velocity. It's as velocity returns to normal and the money supply does not, that you get more spending than usual and therefore you get more inflation than usual. So it peaked at about 9%. And as I said, now it's back down to between 2 and 2.5%. And here's the period of negative money growth. All right, well, let's look at Israel. Same thing before the pandemic, before and during the pandemic. There's no shading here because the U.S. Fred database doesn't call recessions in Israel. But during the pandemic, you got a rise in M3, and that offset a drop in velocity of M3. So it was a 17.7% rise in the money supply, and over the same period, a 15.6% drop in velocity. So the same thing, the central bank gets credit for helping to maintain spending in the face of dropping velocity, which is another way of saying people hoarding money, people trying to stock up on money balances rather than being eager to spend. And so the same prediction and the same thing happens. Velocity returns to trend in Israel. It's right now about back to trend. The Bank of Israel offset the drop, but they didn't fully offset the return of velocity to its trend. And so the same result, inflation is above the trend, was above the trend in 2022. And it's still above 3% in Israel. So it's been slower to return to the 2% target. So here you see M3 well above its pre-pandemic trend path, but velocity is back. So total spending is above path. Yeah, you don't really get a sense of the magnitude here, but it's a smaller gap than in the US. So lower inflation rate. And here it is again in growth rates. So monetary aggregates grew more than 20% year over year in shekels, but money growth is back down to actually below the usual trend right now, or for the most recent figures I've got. Consumer price index peaked after the peak in money growth and now has come back down a bit, although there's been an uptick, which may be due to non-monetary factors in recent months. Okay, so there's a famous saying about inflation that we can now evaluate, Milton Friedman's statement that inflation is always and everywhere a monetary phenomenon. And that's not literally true in that it's potentially some inflation is due to velocity growth faster than normal, and some inflation is due to real output growth smaller than normal. But when you talk about sustained inflation, it's practically always been due to sustained money growth because the other things are transitory. Velocity doesn't vary all that much. So if you want to explain high inflation, it's got to be due to high money growth. Empirically, you can't explain it with velocity or negative real income growth. So that's my interpretation of what Friedman meant to say. Sustained and sizable inflation is always and everywhere a monetary phenomenon because the other two factors just don't have enough empirical oomph. A common theory of inflation is that it's due to budget deficits. But if you break things down in terms of money growth and velocity, you got to ask, well, which one is the national budget deficit affecting? Is it raising money growth? Is it raising velocity growth? Is it reducing real income? If we take away change in money supply, just hold the growth rate of the money supply constant, which is a way of saying we want to talk about pure fiscal policy and not monetary policy. How can a larger deficit raise inflation? Really only by raising velocity. How can it raise velocity? Well, if it raises interest rates because the public sector is borrowing more, and these higher interest rates lead people to want to hold less money because the opportunity cost has gone up with higher interest rates. So they're going to want to hold more government bonds that are now paying more and fewer central bank notes, which are still paying zero. Then in principle, a rising debt could contribute to a higher price level. But there's basically no correlation in the US year to year between the size of the deficit or the size of the debt and interest rates. And that's because the US debt is not just financed by US citizens. We borrow from all over the world. And in general, a government's bonds that are, at least if they're marketable in the rest of the world, some countries they aren't, they have potential buyers anywhere who will go for high interest rates. And so it turns out that deficits don't have much of a correlation with high interest rates, and high interest rates don't have hardly any correlation with velocity growth. So velocity growth isn't a significant factor. And so budget deficits are not a significant factor. That's working through velocity. What about working through money growth? Does a larger deficit cause higher money growth? And the answer is yes, if the central bank responds by printing money to help finance the deficit. Right? A deficit means borrowing, and borrowing implies higher future taxes or higher future money growth to retire the debt. Uh, and so it's commonplace in war times for big budget deficits to be financed by printing money. It didn't used to be common in peacetime, but during the financial crisis and during the pandemic, the Fed worked hand in hand with the US Treasury to make it easier for the Treasury to borrow by the Fed lending the Treasury money, that is, buying their bonds and expanding their own balance sheet. And the Federal Reserve's balance sheet used to be less than $1 trillion. Now it's more than $6 trillion. That's how much they've expanded in the last 15 years. So the correlation's not perfect, but here's the surplus shown as a negative, sorry, the deficit shown as a negative number. And on top is the monetary liabilities of the central bank. And you can see toward the end of the financial crisis, the deficit got bigger and the Fed practiced quantitative easing. The Fed kept expanding even as the deficit returned more to normal. So not really much correlation there. But then they both continue on pretty much the same level until we get to the pandemic. And in the pandemic, tax revenues plummet, so deficits get bigger. And the Federal Reserve prints a lot of money, that is, expands the monetary base quite dramatically. And then it stops expanding the monetary base around the same time that the deficit starts returning to normal. So there seems to be a loose connection. And during the years of really high deficits, the Fed bought an unusually large number of Treasury bonds, and so helped finance the deficits, helped monetize the deficits. Now, the Fed's strategy for monetizing the deficits without it causing inflation was to pay banks not to create more deposits with the additional bank reserves that the Fed was creating through quantitative easing. They were paying interest on reserve balances. So if that was their strategy, then they didn't pursue it vigorously enough. They didn't pay enough interest on reserves to keep M2, money in the hands of the public, from growing quite dramatically, as we saw in previous slides. Whereas in the financial crisis in 2008, they went from paying zero interest on reserves to paying a positive rate. That very much reduced the amount of M2 per dollar of monetary base. That is, the monetary base grew, but M2 didn't grow any more than usual. What about greedflation? Right. So some commentators want to blame inflation on price gouging. My former student, Will Luther, wrote a nice piece on that in which he said, look, businesses are going to charge as much as they can all the time. There's no reason for supposing that at some points in time, all the corporations become more greedy. But what that isn't, it's like trying to explain why there's an unusually high number of plane crashes by saying there was an increase in gravity. There's no increase in gravity. Likewise, there's no increase in greed. It's just a constant. Gravity is a constant. Greed is a constant. But what did change was government made huge transfers to households and businesses. That's the payroll protection plan or the American Recovery Plan. And that was accommodated by the Fed, meaning the Fed expanded buying Treasury bonds to make it easier for the Treasury. So the money supply expanded. And as I've talked about, velocity returned back to normal after initially dipping. So those drove up sales, that drove up business revenue. And business revenue then generated more profits. When there's a sudden surge in spending, it generates more profits for businesses. Those profits are not going to last. They're due to an unusual surge, and competition will bring the profits down by bringing costs up to the new high level of prices. But since retail prices tend to go up faster than wholesale prices, or when the money is injected by giving it to consumers, the first thing to go up is consumer prices. You get a temporary bulge in profits, but both the profits and the inflation are the results. It's not that the profits are causing the inflation. So what do we do about this problem of overly expansionary monetary policy? A common suggestion over the years, going back to a famous article by Kydland and Prescott in 1977, which was largely responsible for their Nobel Prize a few years later, is to say we need to have a rule that guides the central bank, not just leave it to their own discretion, because they tend to react too late, but then overreact. Now, the Federal Reserve supposedly has a rule, namely a 2% inflation target. Turns out it's a pretty weak rule. It allowed inflation to go to 5%. The Fed didn't react. 7%. The Fed only slowly started to react, and hit 9% before the Fed's reaction began to take hold. The picture here, by the way, is Ulysses tied to the mast. His hands are tied behind his back so that he can't steer the boat. And he doesn't want to steer the boat knowing that if he heard the sirens performing here, and I picked one of the more, chaste depictions of the sirens and their tempting of Ulysses, he would steer the boat over and get it smashed on the rocks. So he wants to hear it, but he doesn't. He wants to have his own hands tied. And this is the metaphor for monetary policy by rule. We know the central bank is subject to temptation, not to mention the leads and lags in getting timely information. But so we don't want them steering the boat too eagerly. But there's a second approach, which is a little more sweeping, and that is think about an alternative monetary standard. And that's the subject of the book I showed you on Monday. It was earlier the subject of Friedrich Hayek's book, The Denationalization of Money. And in a nutshell, he wrote this during double-digit inflation in Great Britain. So why do we have such lousy money? Because we don't have any competition. It's competition that we rely on to give us high-quality automobiles and high-quality television sets, TV monitors. We don't have any competition in money. Each central bank has a monopoly, and therefore they can produce lousy money and they don't lose their clientele. Well, let's open the competition, and maybe private firms can provide us with a more trustworthy money. Of course, we now have private issuers of something that hopes to be money, namely cryptocurrency, but it doesn't promise stable purchasing power. What Bitcoin and its followers promise is a stable quantity. There's a predictable quantity of Bitcoin that's programmed in. So you don't have to worry about hyper expansion of the quantity of Bitcoin, but you do have to worry about its day-to-day and week-to-week volatility. Another alternative standard besides Bitcoin would be a gold standard. And if you look at the track record of the gold standard, it's pretty good. It's better than what's followed. It's better than fiat money in terms of restraining inflation. So this chart is by an article by Rolnick and Weber. They took a sample of countries that had both commodity standards and fiat standards. The commodity standards are shown in black and the fiat standards are shown in lightly striped white. And the average inflation rate in every country was higher, has been higher under fiat money. Their sample went through 1990 or 93, I think. Oh, sorry, it's stated on here, 94 for some countries. And even excluding the German hyperinflation, they arrived at an average of 13% inflation for fiat money standards and 1% inflation for gold and silver standards. So that's if you want lower inflation, that's a way to get it. Now, in principle, a fiat money standard could be managed to produce 1% inflation or even 0% inflation. It's a matter of controlling the supply. It just hasn't in practice been controlled that well in any country. Some countries better than others, but maybe with the exception of Japan. Japan has had close to zero inflation, but even Switzerland has 1% inflation as a long run average. Whereas under the gold standard, here's the U.S. price level. So U.S. rejoined the gold standard in 1879 after the Civil War. And the price level measured in units of gold, measured in gold dollars, went through some moves, slightly down and then up again, but pretty much ends up in the same place it started. So gold standards have shown long run price stability. And it would be nice if we could engineer a fiat standard to exhibit at least that much price stability. So this is where I'm going to stop and take questions. Thank you.
First, I want to thank you for the lecture. I just would like to know, you said that most fiat currencies were printed and therefore we got inflation, but there might be private coins or money which won't have inflation. Why don't you think that the tendency to be unreliable and print more than you need is something limited to governments and not human beings in general?
Okay, good question. So what Hayek predicts in his denationalization of money is that private firms, without being bound by any kind of contract, like we promise to buy back the money at the old value if you don't want it, or like under a gold standard, we promise to give you a fixed weight of gold for the currency if it starts to depreciate against gold. He imagines that without any kind of contract like that, firms would promise price stability and would deliver it. And if you ask what's enforcing it, he says, well, the value of the currency, the purchasing power, the price index would be reported in the newspaper, and this would keep them honest. And actually, I'm kind of skeptical that that would be enough because, and this is a theoretical result that's pretty well established in the literature. If you have a profit maximizing firm and there's no legal penalty against printing as much as you can before people catch on, there's a big profit there from cheating, from breaking your promise. It's true you only get to do it once, but if that profit is big enough, it's worth doing because the alternative is to stay in business and just earn a normal rate of return. Wouldn't you rather have a super normal rate of return and then afterwards you can invest it and earn a normal rate of return? So you come out ahead even in the long run. It's true you've thrown away your brand name, but you cashed it in. You got something for it. So this is a problem of time inconsistency. If the promise is not in any way legally enforceable, I'm not sure it's so reliable. Historically, banks that issued gold redeemable money were held legally to their promises. So if they don't redeem, they get shut down and the proceeds get distributed, and there aren't any excess profits for the shareholders. And so that was a time consistent system. There wasn't a chronic problem of banks overissuing when what they issued was redeemable for some more basic money, which was limited in quantity. So under a gold standard, the quantity of gold did grow slowly over time, but not any more rapidly than the output of goods. So you got close to zero inflation. And I talk in my book about why actually you should expect that. Because if the value of gold starts to fall because it's growing more rapidly than the output of goods, that'll discourage gold mining. And so it'll stop growing so rapidly. And on the flip side, if the output of goods is rising faster than the output of gold, which happened over some decades, that raises the purchasing power of gold. That gives gold miners an incentive to dig deeper and produce more gold. So the supply responds to the demand with a lag, but over the long run, over 10, 20-year horizon, there's mean reversion in the purchasing power of gold. You don't get that with fiat money. You don't get that with Bitcoin.
For me, it sounds like a story of someone who broke with their ex a few years ago, and now he's thinking of coming back. Yeah, we're not very happy with our current boyfriend, but can you tell more about the reasons that we decided to move on from the gold era, and what did we benefit from the new stages, and maybe was it too greedy to try to fly off to our own adventures?
So the historical break from the gold standard came during the First World War. And basically all the major nations in Europe went off the gold standard to help finance the war effort. And they were able to do it because they just had one issuer of currency, namely the central bank. And when the central bank says, so nobody else is issuing currency redeemable for gold, all they're issuing are checking deposits. And what are they redeemable for? They're redeemable for the central bank's currency. So when the central bank says we're not redeeming anymore, well, then nobody's redeeming anymore in gold or silver. And so you're off the gold standard. After the war, some governments tried to go back on the gold standard at the old parity. So Great Britain tried to go back, put the pound back on the gold standard at the old parity, meaning so many ounces of gold per pound, or the flip side is so many pounds per ounce of gold. The problem is they had printed so much money during the war that the price level was about 3 times as high as it had been during the war. And so the gold pound bought 3 times as much as the paper pound. And when that's true, you can't just restore interconvertibility. You can't let everybody redeem their paper pounds for gold pounds. The central bank will immediately run out of gold. Everybody will want to make the redemption because they can buy more with gold pounds than with paper pounds. What they did in Great Britain was they tried to go back before they had brought the price level back down. And that meant there was great pressure to redeem, which they tried to stop by putting all kinds of obstacles in the way of redeeming. But pretty quickly, the Bank of England was running out of gold reserves, and they said, we can't do this anymore. It was forcing the price level down in a way that was depressing the economy. And they said, we don't want that anymore. And so they went back off the gold standard. And in other countries, you had similar efforts, some half-hearted. In some countries, you had devaluations like France, which was a more sustainable policy. A famous anecdote from the economist Ludwig von Mises, when he was asked, should we have a deflation that after the First World War to restore the gold standard to its old parity? He said, look, if you've run over somebody with your automobile, you don't do them a favor by putting the car in reverse and running over them in the other direction. So he's saying, look, this inflation has been enormously disruptive, but an equal deflation would also be enormously disruptive. So just devalue and go on with it and promise never to devalue again. Anyway, so I blame central banks rather than the internal workings of the gold standard. Central banks went off the gold standard, and then it was hard to get back on at the old parity, and it was politically unpopular to devalue, and so they kind of made a hash of it. After the second, and so the interwar period is just chaotic all over. After the Second World War, they tried to come up with a new stable system, but one that wouldn't need as much gold in central bank vaults because they had a lot more currency to back and they didn't have any more gold. So they said, okay, instead of making our currencies redeemable for gold, we'll make them redeemable for US dollars. and will make the US dollar redeemable for gold because the US still has a lot of gold. And in fact, they gained gold during the First World War and they gained gold during the Second World War. It flowed in from Europe. And the US Treasury liked this system because now the dollar is the boss. Problem with that system was, as the earlier question referred to, there is a temptation. There's a temptation to take advantage of the opportunity to print dollars and buy goods from the rest of the world and have the rest of the world just end up owning more dollars because to the rest of the world, dollars are a reserve. You just stick it in the bank vault. Well, foreign central banks still had the option to redeem dollars. So when the overissue of dollars, that is too many dollars to maintain $35 an ounce of gold, they started to redeem. And in particular, France insisted on redeeming. But at the end, even Germany, who had been cooperating under the threat that the US would pull its troops out if they started redeeming dollars for gold, even Germany joined the run on the dollar. And Nixon closed the gold window in 1971 because the Fed was pursuing a monetary policy inconsistent with $35 an ounce, a monetary policy that was raising the price level so that the dollar bought $35 bought less than an ounce of gold on world markets. So that's the end of the gold standard. So some of my friends who are Bitcoiners tell me, well, you see, you can't rely on a gold standard because the government can mess it up. And I think historically that's true. So we would need some kind of constitutional constraints to make a new gold standard more durable than that. But unfortunately, I don't see Bitcoin being immune from government messing it up either. It's true if you're sophisticated and you operate on the deep web, you can transfer Bitcoin without the government knowing about it or being able to stop it. And there are people even in China today who exchange with Bitcoin in order to keep their transactions secret. But it's underground. Governments have enough power to drive cryptocurrencies underground. And so they're not going to outcompete the established fiat money when they're illegal to use, unfortunately.
I wanted to ask about the relation of inflation to the stock market. Every month, the Fed publishes the year-over-year and month-over-month inflation reports, as well as the CPI, basically the numbers you showed in the beginning of the lecture.
Right.
I wanted to ask about the relation. We see a strong reaction in the stock markets every time the report comes out, basically a reaction to the news. I wanted to hear your take on this and what's to be expected in the near future.
Okay, good question. So the long run relationship is that inflation raises the price of goods. So corporations that are producing and selling goods get more revenue, but it also raises wages and the price of raw material inputs. So they have higher costs, and it doesn't really raise their profits. Inflation does not raise profits in any permanent way. Just as I said before, a surprise increase in spending will raise profits temporarily. But a chronic ongoing inflation is not associated with higher profits. But it is associated with price information becoming a little noisier. And for that reason, it's a little hard to evaluate whether a firm is making a profit right now just because there's a temporary surge in spending as a kind of lagged response to monetary policy, or for some more specific to the firm reason that they really have come up with a better mousetrap or their product has become more popular. And so if you put your own savings in the stock market, you won't lose as much as if you invest in fixed income securities with a fixed interest rate. The price of stocks will rise with the price of other goods. Not quite the full amount, though, because the stock market becomes noisier as an indicator. And so people who want to avoid risk and volatility will shy away from the stock market. But the reaction to the news is what you asked about. So if inflation turns out to be higher than was predicted, then people anticipate, well, the Fed's going to respond to this by tightening monetary policy to damp down inflation more than we previously expected, which means interest rates are going to, for a while at least, be higher than we expected. And that means we have to discount the future earnings more heavily. And so a rise in inflation is associated with an expected rise in interest rates and therefore a reduction in the price of shares. So that's the news reaction. It's really a response to what they think the monetary policy response is going to be. And likewise, the stock market sometimes responds to employment reports, because if employment is weaker, then you expect a more expansionary monetary policy, which for a time will lower interest rates and therefore raise the present discounted value of corporate earnings, and vice versa if employment is stronger than expected.
So in the 80s in Israel, there was like a number of drastic measures taken in order to deal with the hyperinflation. And so my question is, on a regular basis, in less extreme cases, what are the mechanisms that encourage the public to have rational as opposed to adaptive expectations for inflation, and to what extent are they successful?
And that's a good question, because if we assume that the public correctly foresees inflation, then inflation does a lot more damage. Sorry, a lot less damage if it's correctly foreseen every time, if it's perfectly foreseen. Rational expectations isn't that strong, but it says that the expectations are unbiased, right? So the errors are equal on both sides. And that means on average, people correctly expect inflation. Then it will do less damage than when there are periods where people systematically under-expect inflation. And I guess if you look at it historically, you can find periods in which it took a long time for the public to catch on to the fact that inflation was going to be higher now. And I'm thinking of the US starting in the mid-1960s. If the public has kind of sluggish inflation expectations, adaptive inflation expectations with not very fast adjustments, then monetary policy has real effects. In particular, you can find a Phillips curve in the data. Higher inflation is associated with lower unemployment. That, of course, depends on the inflation being unanticipated. If you look across countries when inflation is correctly anticipated, you don't see high inflation countries have lower unemployment. It's only when in the transition between a low and high inflation rate that you can get a real effect on employment or on other things. So it depends on the public understanding the regime they live on. And when you switch regimes, it seems reasonable that it'll take the public a while to learn. So in the 1960s, the Fed stopped behaving as though it was constrained by the obligation to redeem the dollar for $35 an ounce for gold. The Fed expanded more than was consistent with that. And it took the public a while to catch on. But when they did, you saw it in the data where the short run Phillips curve suddenly shifted out after 1969. And now the economy had more inflation and more unemployment, which was not consistent with the public having fixed inflation expectations, but is perfectly consistent with the public having rational expectations. I think the concern that the public does understand the way fiat money works, and they understand the temptation to inflate if you can do it by surprise, because it has beneficial short-run results, reduces unemployment, increases real income. That's the logic of Kidlin and Prescott that I referred to their article earlier. And I think that's helped the recognition that all you get when the public understands the game is high inflation without any beneficial real effects, then it's not worth having. And so what's worth having is a commitment to lower inflation. Then you can have low inflation and it won't have any long run negative consequences for the economy, and instead positive consequences. Yeah, so I think unless there's an unexpected change in the monetary regime, we can expect the public to have roughly rational expectations to understand the regime that the central bank is operating under, what temptations they face, and so on.
Okay, thank you, Larry.
Thank you. Been good.
Bye-bye. Bye-bye.